This is where we jump on board, going long. And you can see what happened with price action. It pretty much went where it was supposed to based on this price measurement. So we went long back here when MACD punched up through its trigger line, and we held that trade all the while MACD was above its trigger line, right to about there, and that's where we bailed. We pay attention to what the institutional traders are doing. They trade thousands of lots worth millions of dollars at a time, and as such, they do move the Forex market. And I'm going to, talk about the Australian dollar. This is interesting in that I just showed you this graph as of September 1st. Commercial traders extremely long the Australian dollar. Then on September 20th, I noticed that the hedge funds, the green line, woke up and they were starting to buy the Australian dollar. This may sound more complicated than it actually is. When you see the example I'm going to give you, you'll understand what I'm talking about. Okay, now looking at the 1 hour chart, and you'll notice that we're in an uptrend. We had a golden cross back here, the 50 exponential moving average punching up through the 200. Look at the angle and separation, good angle and separation. This just reinforces the notion that we're in an uptrending market. And we're going to pay particular attention to this area right here for price action, and that was for, this was an excellent buy right here. And a good sell. Now carrying on, okay, there's the buy and sell that I just talked about. Beyond this sell, we had another excellent buying opportunity in that price fell off. After this sell, price fell off. We had divergence on MACD to price. Price rose, but at this point right here, where we had the golden cross on the 5-minute chart, price was above the 50 exponential moving average on the hourly chart, but it was below it on the 5-minute chart. So this was a great buying opportunity in through here. You can see what it looked like on the hourly chart. There's the downtrend reversal that I talked about earlier, where 1 hour traders were buying in here. There is the 143 pip move on the hourly chart. I mean, but who could have guessed? Look at the trend on the hourly chart. Steadily up, 50 exponential moving average above the 200, good angle and separation. No big surprise that we had a rise in price. In other words, what we're doing here is we're putting a buy stop at the number 2 spot, just above the number 2 spot, and when price advances through this level and takes our buy stop, the market has taken us in. In other words, the market has made the decision for us. The price is going up. Okay. So to do a price measurement with a 1, 2, 3 bottom, you measure the distance from the number 3 point to the number 2 point, project that distance north. That's how far price is supposed to go. There's the buy stop with our stop 30 pips below. And who could have guessed? We closed our position shortly after it broke through the number 2 point. The London Open is at 3 a.m. Eastern Time. And so we would like to record the pivots as at midnight Eastern Time because that's 3 hours in advance of the London Open, which means you're getting really good support and resistance levels going into the London Open. So that's the rationale behind midnight to midnight. But let's suppose that you wanted to trade the New York close at 4:30 in the afternoon. You could calculate your pivots over a 24-hour period from, say, 2 one day to 2 the next day. But that said, the way we calculate pivots, you can use these pivots for any trading session. They're good for the entire day. In this particular example, you can see that price fell off down below the central pivot point. You can sell in here, but you want to collapse any of your shorts as quickly as possible because you are in a buy area. So the necessary time to explaining pivots and how they're used, they're very powerful.